Hey class, welcome to lesson number 42. As usual, we start with our homework question first. From lesson 41, the question that was asked was, draw me a flow chart showing monetary policy. Okay, monetary policy works using the way it works is that basically the federal government, or the Federal Reserve Board in this case, what they do is they control the money supply, and the money supply in turn relates to our GDP, or the output. So in a recession, okay, let me go ahead and start off with the recession first, and then we can go into an inflationary period. Okay, so in a recession, what tends to happen is that we have the need to increase the output. Okay, so how do we increase the output? First, what we do is we increase the money supply. Okay, so this is using an expansionary monetary policy. So if money supply goes up, what tends to happen is that the interest rates go down. If the interest rates go down, the investment goes up. If the investment goes up, and here's the link that's going to come up real soon, AD goes up, our GDP goes up. Okay, our GDP goes up. And that's the link, right? That's the way you tie up money supply and our GDP. It's using this middle investment, okay? And so what you're trying to do is once you have investment, right, you can automatically come into aggregate demand. Aggregate demand leads to our GDP. But the key link is to see how all of these connect. So understanding money supply and how it connects to interest rates, how interest rates connect to investment, and how investment connects to aggregate demand how investment connects to aggregate demand is pretty straightforward. But these three are pretty important: money supply, interest rates, and investment. Okay? So let's talk about how we tackle an inflationary period. Okay, an inflationary period, we're trying to tackle prices because they're too high. Okay, they're too high. So in an inflationary period, what we do is that we do the exact opposite, right? We decrease the money supply. When you decrease the money supply, money becomes more valuable. So interest rates actually go up. Interest rates go up. Investments are expensive, so people can't borrow as much money, so investments actually go down. Investments go down, it's pretty straightforward from here. Aggregate demand goes down, your RGDP goes down. Okay, so that should be the link. And finally speaking, the two other links I kind of forgot is if RGDP goes up, guys, your employment goes up or your unemployment goes down. In this case, inflationary period, we got to talk about price levels. Okay, so RGDP goes down, your unemployment goes up. Okay, but finally your price level goes down. All right, price level goes down. So this is the goal of the inflationary period, and this is the goal of the recessionary period. RGDP going up is your recessionary goal, and your price level going down is your inflationary goal. Okay, so that's the flow chart for the monetary supply and how we battle recessions and inflationary periods. Now let's move on to open market operations. We started talking about a little bit about this. We said that the way that the open market operations work is by the buying of selling of bonds by the Federal Reserve. All right. So how does this happen? Let's talk about it one more time before we jump into the selling of Treasury bonds. All right, so basically what the government does is says, hey, you know what? We need to increase the monetary supply, okay? Let's say that we're in a recession, we need to increase the monetary supply. So how does the government do this? Well, they say, let's buy Treasury bonds. And who do they buy it from? They buy it from two groups, okay? Mainly the banks, okay? Mainly the banks, and in a few instances, the public. Okay, but mainly the banks, all right? So they buy Treasury bonds from the banks. How does this work? Well, banks, right, they have, let's say they have $100 million, okay? They're, of course, you said, you know the reserve ratio by now, probably pretty well, right? They're supposed to have, let's say, about 10% in reserve. So out of the $100 million, $10 million should be in reserve. What about the rest of the $90 million? Well, they loan out, right? But they don't exactly loan out everything as well. And also, what about that 10%? They tend to invest. And what do they invest in? Well, I told you guys the most secure investment in the world today is a US-backed Treasury bond. So they actually buy bonds. Banks actually buy bonds as part of their investments. Okay? So what government does is that, hey, government says, you know what? We're in a recession. We need to increase the money supply. Okay? So we want to pump money in. Okay? And I know you, the bank, have my Treasury bonds. So what I'm going to do, bank, is I'm going to buy the Treasury bonds back. Okay? I'm going to buy it back. I'm going to give you money. Okay, so the government gives money, cash, okay, in exchange for bonds, okay? And this is obviously US-backed Treasury bonds, okay? So what they do is when they give this cash for bonds, okay, to the banks, okay, these banks, right, take that money and they loan it out, and that goes into the market, the money market, okay? That goes in the money market, okay? And what does this do? When it goes in the money market, it goes in the form of money supply goes up. And then you guys know how that fixes the recessionary economy, okay? So dollars, okay, when it's time for a recession, okay, how about this? This is the way you remember it, okay? Or whatever works for you, okay? Some people have different ways of remembering this. But when you want a boom, okay? When you want a boom in the economy, you need to buy, okay? Buy bonds, okay? When you want a boom, you buy, okay? What do you buy? You buy Treasury-backed bonds. You being the government of the United States or any other government in the world, okay? But the U.S. Buys bonds and they give cash to the banks. Banks take this cash, put it in the money market. Money market, and you see that as the money supply going up, and the money supply eventually fixes up the RGDP, okay? Couple different links between the money supply and the RGDP. What are the different links? Well, we talked about 3 different links, right? We said money supply, between money supply and RGDP, okay? You have about 3 different things. What are these things? Well, money supply affects immediately. What does it affect? If money supply goes up, it affects the interest rates, okay? They go down. What do the interest rates affect? They affect investment, okay? Your investment goes up if money is cheaper to borrow. What does I affect? Well, that's pretty easy, right? It affects AD. And AD eventually affects RGDP. Okay? So that's how open market operations, that's how open market operations affect the affect money supply, So when you buy bonds, you increase the money supply, okay? So when you want a boom in the economy, you buy bonds, okay? That's the way I remember it. Whatever ways you want to remember it, you guys can go ahead and create your own formulas, and you can use this if you want, okay? So let's talk about the opposite. Okay, so now we talked about, okay, how we create more money in the economy. We said, okay, if you want more money in the economy, what we do is the government, we being the government, we go ahead and we buy bonds, okay? We buy bonds. So what happens when we want to decrease the money supply? Well, we sell bonds, okay? We sell bonds. So a way I remember it, it's pretty silly, but I still remember it, right? If you want to sink, right, the economy, you have to sell the bonds, okay? You want to sink the price levels, you have to sell the bonds, okay? So what does selling do? What does selling of Treasury bonds do? And again, they sell to 2 people, right? The banks who are interested in investing their money in Treasury bonds because they're the safest, US-backed Treasury bonds are the safest investment. And at the same time, us, the public, okay? Because we're interested in investing our money as well. And why not invest it in a safe investment, right? So they sell bonds, and they sell it to us and the banks, right? So what happens is that the government, okay, the government sells bonds in exchange for money. Okay? Government sells bonds in exchange for money. Straightforward, simple. Pretty much the exact opposite. Last time they were buying bonds, which means they were getting bonds and they were giving money. Okay? In this case, they want to sink the prices, so they're trying to sell the bonds, right? If they sell the bonds, they get money back, okay? So banks give money to the government, okay? So the money market, in essence, loses funds to the government, right? It loses funds. So what does that happen? Well, that causes the money supply to decrease, okay? And let's talk about it one more time. If money supply decreases, interest rates go up. Interest rates go up. Well, investment goes down. Investment goes down. AD goes down. If AD goes down, what happens is your RGDP goes down, right? If your RGDP goes down, your unemployment goes up, but the eventual result is that your price level goes down. And that's how you fight inflationary periods. Okay, guys? So the ones you have to understand, okay, this can be a little confusing. It was when I was learning this first, is when do you sell bonds and when you buy bonds. Okay, so make some sort of, mnemonic or whatever you want to call it. I say if you want to boom, you want to buy bonds. If you want to sink the prices, you have to sell the bonds. Okay, so if you want to sink, you sell. If you want to buy, if you want to boom, if you want to boom, you want to buy. So if you sell bonds, well, they take money away from the economy, right? And if they buy bonds, they being the government, they pump money into the economy. And that's how open market operations are done, okay? So open market operations are the buying of selling of bonds. They buy bonds to infuse money into the economy. They sell bonds to make sure that the money is being taken away. Money supply contracts. Money supply contracts, interest rates go up. Interest rates go up, investment comes down. Investment comes down, your AD goes down, AD goes down, RGDP goes down, eventually your price level comes down. Okay? So this is open market operations. Can be pretty confusing if you ask me. So I'll talk about it. I'll give you an overview again a little later. So you remember, okay, if it's inflationary, what do we do? If it's recession, what do we do? We'll try to go this one more time, but make sure you pay attention or you come back and refer to your notes because at least when I was taking the test, the AP test, I seem to have, I tried to remember that, okay, buying of bonds infuses capital into the economy, selling of bonds takes money away. So buying bonds means money supply goes up, selling bonds means money supply comes down. That's something you need to remember. Okay, so let's talk about 3 different things. Let's start off with the federal funds rate over here to my right. All right, federal funds rate, what is it? It's the First of all, it's the rate at which, it's an @ sign, at which banks borrow from each other. And you're thinking, what? Banks borrow from each other? It's true. Banks do borrow from each other. Okay? I guess exclamation mark's a little too dramatic. We'll just stick to a period. All right, so what does this mean? Why do banks borrow from each other in the first place? Well, there's a lot of different reasons. Sometimes what happens is big banks give money to the smaller banks, okay? In a lot of ways, that's normally how it works, right? If you think about Bank of California compared to, let's take a bigger bank like Bank of America, right? They're on a definitely a different scale, okay? So sometimes what happens is that they don't have enough money to cover their reserves and they borrow money, okay? And the way they do is that they go to the bank, the small bank goes to the big bank, all right? In some cases, actually big banks go to other big banks. It just depends. But the federal funds rate is the rate at which they borrow each other, okay? All right, so let's go back to federal funds rate, right? We're talking about the rate at which banks borrow from each other, and we said small banks, well, they borrow from big banks, okay? Or big banks borrow from other big banks. So, but the point is that the Federal Reserve Board monitors the federal funds rate. Why is that true? Well, this rate happens to be the rate that is targeted by the Federal Reserve Board, by the feds. Okay, so this is the rate at which they target, right? Now, I'll tell you something that, obviously they have an indirect control over the federal funds rate, but this is the rate at which the banks actually borrow to each other. So this is the trickle-down interest rate that happens to come down when, so there's a couple different things going on, okay? Let me rephrase. When it comes to borrowing money, okay, the Federal Reserve Board gives money to, let's say, big banks, okay? And then big banks give money to the small banks, okay? And they both give money to the public, okay? Both give money to the public, okay? The rate at which the Federal Reserve or the federal government gives to the big bank, okay, the big banks, is called the discount rate, DR. Okay, discount rate. I'll go over that in the next in just a few minutes. The rate at which the big banks or banks give to each other, the rate, this rate right here, the rate at which they borrow to each other, is called what we just talked about, the federal funds rate, FFR, standing for federal funds rate. Okay? But the point is that if they dictate this rate right here, because the Federal Reserve Board has a control over this discount rate, right? This is the rate at which the big banks get it. But the point is that this is the rate that's closer to reality, because this is what hits the public, okay? So they monitor this carefully because this is what they want the actual interest rate to be, okay? And depending on what the interest rate is, they kind of change the money supply so that they adjust the interest rates. Remember, money supply going up means that interest rates come down. Money supply going down means the interest rates going up. By far, they use open market operations to control all of this, meaning that they sell and buy bonds to make sure that they control the interest rates. Okay? That's how they have a big control. But they also have a control over this guy right here, which we're going to talk about, called discount rate. So as we all know, right, banks need money themselves, right? They need to borrow money, right? So small banks can borrow from big banks, but so what do the big banks do? Yeah, they can go to each other, but at the end of the day, they also go to the federal government, okay? So the federal government says to Bank of America or to Citigroup or any big bank, they say, hey, you know what? Yeah, you can take the money, but you know, nothing. There's no such thing as a free lunch, and there's money to be paid there. So the rate at which the federal government gets to dictate how much money they can, how much interest they charge for the big banks is called as the discount rate. The discount rate, okay? This discount rate is the interest rate. Interest rate. For banks to borrow from the federal government, okay? Federal government, okay? So this is the rate, the discount rate is the interest rate the banks borrow from the federal government. So Bank of America goes to the federal government and says, you know what, we need $1 billion. Federal government says that's fine, but we're going to charge you 4% interest rate. Okay, and with that, Bank of America takes that money and then they give it out to, let's say, a Bank of California. It's smaller, right? And they might charge a little more. They might say 4.25% and make a profit on that. And that's called as a federal funds rate. Make sure you know that because that might show up on the test. So don't confuse the federal funds rate. Even though it has federal in it, doesn't mean that the federal government is controlling that. They only indirectly control it using the discount rate. So make sure that you know that the discount rate is something that the federal government can control directly, but the federal funds rate, which is the rate at which banks borrow to each other, is something that's indirectly controlled, okay? Because this discount rate trickles down to the federal funds rate, all right? Make sure you remember that. So how does the discount rate affect the economy, right? How do we talk about money supply using the discount rate, okay? Here's how it works. Just like anything else, we've talked about this before. What's the basic principle we've always tried to talk about when it comes to monetary policy? Well, we said that if the money supply is high, we said that the interest rates are low because the cost of borrowing money is cheaper. So here's how it works. If the discount rate is low, normally what tends to happen is that the excess reserves go up. Why is that true? Why do the excess reserves go up if the discount rate is cheap? Okay, now think about it. Okay, you're a bank. Let's take a big bank like Bank of America, and you come to the federal government. Normally, it's about 4% to borrow, but things are going. The federal government decides we need to help the economy. We're in a recession, so we're going to cut the interest rate to 2%. Okay, so it's half. So Bank of America says, hey, you know what? Wait a minute. If I take 2%, right, and loan it out, right? If I take $1 billion and loan out at 2% and loan it out at 4%, I get to make a good amount of profit. So what that's saying is the discount rate, as it comes down, money becomes cheaper for banks to borrow. Okay, it becomes cheaper and cheaper, and so what they get to do is make a bigger profit. So what that tends to do is it tends to increase the excess reserves in the banks, because the banks will say, hey, you know what, the discount rate is dropping. Let me go ahead and take that money and loan it out to people. So immediately the excess reserves go up as the discount rates fall, because it just makes good economical sense. So then we've tried to understand how that increases the money supply, because what they do is obviously no bank wants to keep their money idling. Okay, they don't want it. Okay, they want to give it out to loans. So they immediately move that and put it out in the money supply so that people can borrow the money. So money supply goes up. And from there, everyone knows what happens, right? If money supply goes up, we know that eventually what happens is that our GDP goes up. All right, now let's look at the opposite scenario. What if it's an inflationary time and the discount rate is being increased by the Federal Reserve Board? Well, the exact opposite happens. If it's increasing in discount rate, well, we personally don't want to infuse as much money, right? So the excess reserves tend to drop. Okay, excess reserves tend to drop. If this is true, well, then the money supply shrinks. And then you know what happens from there. The price levels tend to drop. Okay? So this is how the Federal Reserve Board has the discount rate as a tool so that they get to control the money supply. So you get to really hit money supply on 3 different ways, right? First and foremost is open market operations, using buying bonds to put money into the money supply, and then selling bonds to take money away from the money supply. 2 is the discount rate, right? The rate at which the banks get to borrow money from the government. I'll say that one more time. Discount rate is the rate at which the banks get to borrow money from the federal government. And lastly, right, we're going to talk about the reserve ratio, which we talked about already a little bit before, right? We already talked about this. We said the reserve ratio is the ratio that's required. Like, this is a pretty dry definition, but we have to know this by now, right? The required reserve ratio is the ratio that dictates how much money can be in the reserves and how much money can be loaned out by the banks, right? So the RR stands for reserve ratio, which goes into another thing called a money multiplier, which we talked about already before. So what is a reserve ratio? It's the amount of money required by the federal government, okay, to be put in reserves. So the banks must have, let's say it's 10%. Let's say reserve ratio is set at 10% by the federal government. Banks must have 10% at all times of all their deposits with them, okay? So if someone walks in and says, you know what, I want my money back, they're ready to give it and the economy doesn't crash. Okay, so that's a reserve ratio. How does this get to dictate the money supply? We already danced around this issue a little bit before, but let's actually make this concrete. If we decrease the reserve ratio, we being the Federal Reserve Board, what happens? Okay, well, we decrease the reserve ratio. It means that it's saying the banks, you know what, you guys don't have to keep 20% in a reserve anymore. We'll have that. Let's make that 10%. Oh, banks is fantastic. You know what? I can take that 10% out and I can loan it out and make profit on that. So what immediately happens is that their reserves, the money flows from their reserves to their excess reserves, which eventually will be loaned out. Remember that. That's their goal. That's how they make their money. Excess reserves. Okay? So if excess reserves go up, and we've seen this link before, the money supply tends to go up. Okay? Now the exact opposite, if your RR goes down. RR goes down, RR goes up. What tends to happen is your excess reserves will fall, ER falls, and money supply falls. Okay? What does this do? What does the increasing the money supply do? It fixes recessions. What does the money supply going down do? It fixes inflations. Okay? So reserve ratio is another tool that the federal government can use in order to battle a recession or an inflationary period. All right, let's come to a conclusion about this. Okay. What is the conclusion? So when it comes to monetary policy, let's have some sort of conclusion that says, all right, so if I'm in a recession, what do I do? We talked about three tools already: open market operations, federal fund rate, not federal fund rate, the reserve ratio, and then the discount rate. So let's talk about a recession. Okay, what can we do? It's a recession. Oh no, banks have failed. What do we do? Okay, question mark. What do we do? One, let's lower the discount rate. Okay, lower DR. What does that mean? When you lower discount rate, the rate at which the banks get to borrow from the government, okay, it's cheaper to borrow money. Okay, it's cheap to borrow money. So what the banks will do is they'll increase their excess reserves, take that money from the government, loan it out to other people. So by that, what I mean to say is that the money supply has gone up. If money supply goes up, our GDP eventually goes up, and we try to get out of the recession. Okay, so that's a tool. What's another one? Lower the reserve ratio. What is the reserve ratio? The amount of money required by the banks to be with them at all times. So if you lower the reserve ratio, what they can do is they can take money out of their reserves and put it in the excess reserves, which they'll loan out, again increasing the money supply, again increasing the RGDP eventually. Third one, most importantly, is an open market operation. What do? Do you buy or sell? Well, you buy, okay? You want a boom, you gotta buy, okay? You gotta buy bonds, okay? Buy bonds. So if the US government decides to buy bonds, okay, what they do is they will go ahead, and all the banks that hold bonds, they'll say, you know what, we want to buy $1 billion in bonds. Let's take that $1 billion. I'll give you $1 billion in cash. Let me get $1 billion back in bonds. Okay, so they'll take that, infuse the capital into the money supply. Money supply goes up, and eventually you've got an RGDP that's going up. Okay, so that's how you battle a recession. All right, now we've got how do you battle an inflation on this side. Okay. Let's talk about how do you battle inflation on this side. All right, inflation, sort of the exact opposite, right? Let's start off with bonds, okay? If you're buying bonds in a recession, during an inflation, you want to sell bonds, okay? Because if you sell bonds to the people and the banks, they take the bond and they give you money, so the money supply goes down. Excellent, money supply goes down, price level goes down. Two is you increase the discount rate, increase DR. If you increase the discount rate, it's more expensive for banks to borrow money. So they're going to stop borrowing as much money. And that's going to drop the excess reserves, which eventually is going to drop the money supply. Okay, again, dropping the price level. Great. Lastly, we can increase the reserve ratio. So we're going to say, hey, you know what? Bank of America and Citigroup and all the banks in the world, or the US rather, we as the Federal Reserve Board, are asking you to increase the amount of money that you have at all times. And the bank says, oh no, we have to take money out of the excess reserves and put it in our reserves, and we can't loan as much money. What that does is it decreases the money supply, and that decreases the price level. Okay? So inflation and recession, this is the monetary policy overview. Okay? So pretty much that's the overview behind me. Again, I want to reiterate the fact that there's three ways to use monetary policy. One is to change the discount rate, two is to change the reserve ratio, and three is to use open market operations, namely buying and selling bonds. The homework question for this particular lesson is going to be basically what the board is saying behind me. Explain to me in a recession what we do using monetary policy. Explain to me what we have to do. And explain to me in an inflation what we have to do using monetary policy, okay? So there's 3 steps in both, 3 tools in both, and explain to me both in inflationary conditions and recessionary conditions.